Entrepreneurship
on 702.
14 minutes after 9 o'clock. Let's sharpen those curiosity swords. Please give us a call even now on 011-883-0702 as we look at this topic. Numbers don't lie. Check the scoreboard, linking value creation to numbers and demystifying financial statements. Andisa, good evening to you, sir. Thank you very much for joining us. What does that mean, man?
Thank you, Aubrey.
Yeah.
Thank you, Aubrey.
What does that mean? Yeah.
So
numbers don't lie. Check the scoreboard, linking value creation to numbers and demystifying financial statements.
So I stole that line from Jay-Z from the song called Tom Ford.
Ah, okay.
It says numbers don't lie. Check the scoreboard, and basically that's what it is, right? Business is a game, like a game of life, and how do you know whether you're succeeding or not? Is the scoreboard, and the scoreboard of business is financial statements. Basically, whether you are creating value or not, and we'll unpack the buzzword. But what we are trying to do with the series, because we've been having conversations, you and I, is trying to link all these concepts together so that we build capabilities, or at least some thinking patterns within entrepreneurs, so that they're able to practically put these things in use. I'm sure I'm not the only entrepreneur or consultant rather who gets approached by entrepreneurs more often than not to say, help me put a business plan together. And a big component of those business plan is the set of financials that go with them. And what I've found quite bizarre is that entrepreneurs tend to not to look too much into what the consultants put together, because for lack of knowledge, obviously, whatever business plan they want to use is to unlock funding somewhere without really applying themselves to say, but what is this document saying? And the concepts that we've spoken about, you and I have, if you think about them, it's really how to plan your business, how to put your business plan together. So if you've been following our conversations to date, we've put everything around creating a business plan. And this is now the final component around financials and how to think about financials and demystifying them, because most of the time people are scared of numbers. I mean, a lot of people think these financials are mathematics, which, by the way, they are not. And part of that education is to demystify and create that comfort. We're not obviously going to create experts overnight.
So you're saying to me that these financials are not mathematics?
No. In fact, I would even dumb them down and say they're just arithmetic. Arithmetic is it's not even mathematics, right? Because mathematics is broad and encapsulate much more. But this is just addition. 1 + 1 = 2. But there's a set of prescripts and rules that apply to how you put this 1 + 1 into twos, and a lot of people will call them accounting standards.
That is critical.
Absolutely.
Because a lot of us are intimidated by financials because we think it's mathematics. Yeah. And because we come, many of us, from a background where mathematics has been a very intimidating subject. The very idea that there's a piece of paper with lots and lots and lots and lots of numbers is a very intimidating one. So I want to stay a little bit on the idea that the financials, and again, maybe a more lay term for what we're talking about when we say the financials, right? What is that? What are we talking about when we're saying the financials? That we need to understand that we are not dealing with pure mathematics here. These are just the accounting principles that speak of how the business is doing.
Is performing, absolutely.
At a particular moment in time. And if we just remove the idea that we are dealing with some big mathematical equation here, which is in and of itself a very intimidating idea, then perhaps we can approach dealing with financials in a way that suggests that we are reading the story of a business.
Absolutely.
Right.
Absolutely.
Okay?
Absolutely. So, and I guess critically what we're going to do is link it back to the conversations we've had around value creation, because that's where it all starts.
Yeah.
If you remember, I said there were three elements of value creation. There was the desirability part where we talk market segments and value propositions. There was the feasibility part where we talk work that needs to be done, the resources that you need, the strategic partnership. And then there was that final element that says is this business viable? Because we said from the value proposition, you are able to sell to the market, because ultimately those are the funders of the business. And from the feasibility, that's where you incur costs. And this is where now you generate viability, because it's simply taking the revenues that you make out of the desirability element minus the cost from the feasibility element, and whether you are making a surplus or not. So we are trying to expand that element today of the viability. And I'd like to offer maybe as a basic thinking building block, right? That says, how do you measure whether you're creating value as a business or not? And it's simply having to do with this arithmetic, right? That says, are you building, are you growing the business? And you hear, and the buzzwords we spoke about, you always hear this term balance sheet.
Yeah.
Does your business have a balance sheet? And by the way, every business has a balance sheet. The question is it healthy or not, right? And the balance sheet simply has three elements. And let me try and unpack them for you so that you'll see how simple they are. A balance sheet simply says that the business has assets that it uses to generate that income that we spoke about. And there's two ways that you can buy those assets. It's either you go to the bank or go to other debt lenders and get that debt, or you use your own money or get someone to buy equity into your business to buy those assets. That's what a balance sheet in its simplest form. And you'll see it's not rocket science, right? It's assets, and it's either two ways you can fund those assets. It's either you raise the liabilities element of them, or you can fund them using owner's equity, which is the cash injection. But there's quite an important element about owner's equity that a lot of people don't probably realize, is how do you link that up to what we call an income statement, right? So how a balance sheet is able to grow. Think about it. So you sell stuff at the end of the day. That's what your business does. And to sell that stuff... Goods and services. Right. And those goods and services are often a function of those assets you have in your balance sheet. For example.
Yeah.
Those are the assets we talk about.
Yes.
So
the frying pan.
The frying pan.
The oil.
And the oil.
Well, the recipe.
We'll come to the oil as well, because that could be inventory of some sort, again, sitting as an asset in a balance sheet. But if it used, it then become what we call a cost to deliver those goods. But you sell amakunya wako, you realize income, you then pay for those goods sold. So oil and stuff, that becomes the cost of the goods sold. And then ultimately you deduct other and I'll come back to them, other components of the income statement. That leaves the net profit. That net profit grows every year in, year out. And that's the one that grows the balance sheet, because it comes back as your own money that then gets capitalized as part of your owner's equity. And this is, by the way, how you create the value. And this is how the business grows, because the balance sheet at the end of the day becomes a function of that. So if you do that month in, month out, year in, year out, and you're able to show that surplus every year, that surplus grows over time. And this is how you grow your balance sheet. This is as simple as it is.
Let me try and see if I understand you correctly. What we're trying to do here is we're trying to create a story.
Yep.
Right? And that story is the story of this business.
Yep.
And that story is the story of this business and whether or not this business is viable.
Yep.
Is it making money or is it not making money? Right. That's what you're talking about when you say it's got a positive or a negative growth trajectory.
Yeah.
Right? That story is called the balance sheet.
The balance sheet, yeah. That's the ultimate, I would argue, is the ultimate financial statement. And hence, that's why you'll always hear when someone says, I need to raise funding, always the question will be, but do you have the balance sheet to do it? And that's obviously as simple as...
Well, and let me ask about that. So if I want to have funding, if I want to raise funding from institutions out there for my business, I should have a balance sheet.
A balance sheet. So if you remember, you and I, you asked me the other time, I did say, maybe let me take a step back to say balance sheet is a very simple thing. You've got asset on one hand, and the way that you can fund those assets is through liabilities, which the money that you get from the bank, or the owner's equity, which is the cash injection that the owner puts in. And we argued the case of venture capitalism for startups, by the way. So by the way, it says that for you to get those assets, you need to have a balanced structure of that capital, by the way. And hence the reason why banks more likely would not fund you if you don't have the equity element. You can understand that your balance sheet is lagging because it does not have the equity component.
The equity component is what you put into
what
the
you
business.
Put in.
Right.
Yes.
Okay. Right.
And I linked it, by the way. I know it can get complicated, but that's the thing that says initially it's what you put in, but over time is what you are able to realize a surplus from the ongoing trades of the business.
Right.
This is how it gets grown over time.
Let me make you pause there and say to the listeners, you're looking for funding, right? You're looking for money to finance your business, right? Well, you got to have a balance sheet. You've got to have a thing called a balance sheet, right? And the balance sheet is the story of whether or not your business is worth investing in. In other words, the balance sheet is the story that tells those that have money that yes, we can invest in this business or not. If you don't have that story, the balance sheet, then most investors or funders are not even going to look at you.
Yeah.
So have you started the mentality of understanding that if you are going to go out into the market and look for funding, then you must have a balance sheet? The balance sheet, according to Andisa Ramavhunga, is a very simple document.
A very simple document.
And as much as it may have all sorts of numbers on it for accountants and all of these very clever business people to read, it is not mathematics, says Andisa Ramavhunga. It is, in fact, a story that you need to know how to read in order for you to understand what your business is understood as by those who make the funding. Is that the right story?
No, that is exactly, Aubrey. And I want to simplify, even take the concept further to say the equity element of it is what we call skin in the game. And this is what the banks will typically be looking at. So you can imagine having I mentioned there's three components of the balance sheet. There's the asset side.
Yeah.
And those assets is either you buy them through debt or you put in skin on the game. So you can imagine going to the bank without that equity portion, where you're saying to them, fund me to get these assets and I have no skin in the game. I mean, this is now putting it in very layman's term and maybe trying to create a case of why the balance sheet is very important.
What have you committed from yourself into this business?
Into this business,
right.
Yes.
Okay. Yeah. And that's what you call equity.
This is what we call equity. So, but there's also a story that the balance sheet tells, right? And we'll unpack it again because I do believe that there's a simpler way of linking these concepts together. So it tells three things about the business. How are you making your operating decisions? How are you making your investment decisions? How are you making your financing decisions? That's a very critical thing. So the investment will come obviously from the assets that is either on the asset side and how you fund them, as I've mentioned them. So you can either fund them through equity or liabilities. The operating decisions is how you grow the balance sheet through that owner's equity part, linking it now to the income statement, which again will also simplify it. You'll see how simple it is, as well as the financing decisions. By the way, that looks at the two elements, whether you're getting the debt in or out, or you're selling the stock. By the way, if you're getting a venture capitalist coming in, essentially what you're doing is selling the stock. So those are the components of the balance sheet that you need to think about.
That makes sense. That makes a lot of sense. So, if you get a venture capitalist to come in, you're essentially selling the stock.
Yeah, that's what it is.
That's what it is, right?
Yeah.
Let me just have this moment. So whenever I hear on Bruce's show, for example, that a particular company has sold its stock, that simply means that a venture capitalist has bought a portion or equity in that business.
Well, it could be any other investor, not necessarily venture capitalist. Sure, it could be other investors. Yeah, but they are looking at the equity portion of the balance sheet. And by the way, they get that cash in. What they do is they typically buy assets with them. It's a way of getting the business up and running. And there are two critical components, by the way, because we can even split the assets so that you can see the linkage. There's what we call cash assets, which is the money you have in the bank. By the way, you can get it from equity or you can get it from debtors, but typically you don't want to get the funding from the debtors and put it in a bank because you want to put that into because it's got a cost. It's which is a due in commitments in a short term. So that's in a way how you fund a business. But I want to stress the importance of understanding at least those three elements of the balance sheet to say whatever decision you are making on your business, from that value creation element that we spoke about in terms of your strategy, will ultimately impact all these three elements of the balance sheet.
Give me those three elements again.
It's assets.
Yeah.
And those assets, there's two ways that you can buy assets. It's either you borrow money or you get equity injection.
Right. Friends, fools and family.
Friend, fools and family, and an investor that wants to come in.
Right.
They could be
or your own savings.
Or your own savings, yeah.
Right.
That would be the skin in the game.
Right.
Or the bank that comes in, which is now that's the debt portion.
Right.
You put those together, they all must equal to assets.
Right.
On the other, so you spoke about the equation at the other end.
Yes.
For those of the listeners who are listening, that basic accounting equations, they always say assets equals to liabilities plus owner's equity. It's in the simplest term what it is.
All right. Slow down. All right. By the way, give us a call. 011-883-0702. We are learning what the balance sheet is. Yeah. That's the story of your business.
Yeah.
But it is written not in sentences as you would a book, right?
Yeah.
Like as you would prose.
Yeah.
It is written in terms of numbers that represent certain things to those that know how to read this book.
Yes.
This book tells a story about you, the owner of the business, what the business has, how it moves what it sells, right? And whether or not it's making money or not.
It's creating value. Absolutely, yeah.
The making money is what we call creating value.
Absolutely.
All right. So when we say a business is creating value, we are actually saying, is this business making money?
Making money, yeah. So I gave you three elements now, right? Yeah. I said it's assets equal to debt and skin in the game, right?
Right.
You want to grow that part of the balance sheet that's called skin in the game. That's the value of the business. Because think about it, the debt is not your money. You need to pay it back eventually. But where ultimately you'd want to be as a business is when that asset side of the business equals to that skin in the game. This is how you really grow the business. There was the gentleman I think you had 2 weeks ago, Papa G.
Yeah.
I believe when he said
he's coming after you. Yeah,
he spoke something which is another. In our world, is called a net asset value.
Yeah.
Of the business. Again, that's a balance sheet. You're basically saying of the assets that I bought after I've settled my liabilities, how much of it is left, and that's the value of the business, and that's how much, in its simplistic ways, a business is worth. I know the finance pundits will come in and say there are other ways of valuing a business, but for simplicity, this is how I think as entrepreneurs we must start thinking about value creation and whether our venture is creating value over time.
So the fact that you've got a business that's running, you've got stock, people are coming to buy your amakwinya or whatever it is, does not necessarily mean that business is a valuable business.
No, absolutely. So we'll throw in other buzzwords as well, right? Buzzwords like bankruptcy and insolvency.
Yeah.
So basically what it means that if you were to look at your balance sheet, the portion that you owe in terms of debts is greater than the assets that are available in the business. Basically, it means that business is bankrupt. It has absolutely no value because the equity portion or the skin in the game portion is basically a zero or negative.
Give us a call, 011-883-0702. Let me see if I understand the conversation thus far. When we speak of value in a business, we simply mean whether the business has got money or not.
Yeah.
2, we are also saying that there is a means, there is a way by which funders, financiers, learn about your business, at least at a glance.
Yeah.
And that is a document called the balance sheet.
The balance sheet, yes.
The balance sheet tells the prospective funder a story about you and your business.
Yeah.
And whether or not you are a viable enough business to fund.
To fund, yes. Absolutely. Absolutely.
And without a balance sheet, you can't go into formal venture attainment.
Yeah, so I want
I'm not even sure if I'm asking the question properly.
I hear what you're saying. Yeah? So I wanted maybe to take a step back and say, look, there's areas where they'll want, obviously, what we call audited financial statements, but I'm not there yet, right?
Right.
Because we are trying to get entrepreneurs, particularly the ones who are starting out and hiring consultants to get them to write business plans, is to say, hang ten, maybe think about how you approach value creation, right? Because as I've mentioned, this is very fundamental to the operating, financing, investment decisions that we make into the business. But ultimately, think of value as a balance sheet. I sort of like let it slide, Aubrey, when you say it's about the cash, right? Cash is a big component of it, but there's much, much more to a balance sheet. It's basically those three elements I said you have to think about, which is assets equals to, or how by the way, when I say equals to, because this is an equation, right? That says there's two ways you can fund it. It's either you go borrow the money, or you put in skin in the game. And ultimately, you want the value that when you take out the assets, I mean the debt, there's some value left. This is what we call the net asset value,
right,
of the business, and that could be made up of a function of other things. So we're saying that business has some cash. It has some assets as well, and those assets could be long-term assets like buildings and vehicles, but also some short-term assets like abantu abakweletayo who sit in
people that owe you money,
owe you money would also be realized as asset. But that's so you're talking about
intellectual property.
Intellectual property will sit under assets as well,
right? Okay.
If you value it, so this is when we start getting complicated, and this is where probably I would say as an entrepreneur you need to get in accountants to come help you. Right? When you start valuing things like intellectual property that in a market would not have, or the value of them would be misunderstood and cannot be probably priced correctly. We have things like goodwill as well.
We have a couple of calls.
Yeah.
But before I take Piri in, Alex, I want the listeners out there to understand that it's important for us to understand how to enter the business game as effectively as possible. It's important for us to understand that ours as entrepreneurs is to create value.
Yeah.
Ours is to make sure that we owe less.
Yeah.
And own more.
More. Yeah.
We ultimately we want to owe less and own more.
Yeah.
And when we own more, then the business has more value.
Absolutely. Yeah.
But the business can look like it's operating, but running really on debt.
On debt, yeah, which is unhealthy, yeah.
But if it's just running on debt, and maybe you can see nice trucks outside and you can see people walking around in uniforms and it's a beautiful looking business, it might be a business with very little value because it owes more than it owns.
Yeah.
No,
absolutely.
And this thing called the balance sheet will tell us.
Will tell you that. So by the let me even excite you even more, Aubrey. You'll see why the balance sheet is important.
Yes,
and all these buzzwords.
Piri, I'm with you, man. I'm with you just now, right?
All these buzzwords you hear have to do with a balance sheet. So if you think things like bankruptcy and insolvency, it's a balance sheet thing, which means that example you spoke about of having more debt than assets. If you and there's quite an interesting term, I'm sure you've heard about it as well, called leverage and gearing.
Yeah.
This is where now you start getting into the corporate finance side of getting money to work for you, where you need to get a capital structure, because it's also not too healthy to run all. Although we stand guilty of this as a business, where we run all our money with very little, all our business with very little debt and mostly the equity. A portion, and trust me, it's a very, the risk is minimal, but obviously the growth of it is hamstrung, right? Because at some point you would need to balance the equity portion with the debt portion, and that's what's called leverage or gearing. For other people who
Let me just, you're moving it a bit too fast. Give us a call on 1188307. We're going to start talking about gearing and leveraging in a few moments time. But I'd love to take your calls. 1188307 to the balance sheet. You need a balance sheet. Do you know what a balance sheet is? Can you read a balance sheet? Do you know what finances are reading into your balance sheet?
Yeah.
Do you understand what is the value of your business as things stand now? Yeah?
Yeah.
See, Andisa, I come from the background that says, if the taxi's got petrol inside.
Yeah.
And you can drive around and pick up people and take them to town and come back, then you've got a business and you are sharp.
Yeah.
But what you're saying to me is that very combi, that taxi, if it's still owing, and if you took that petrol from a scoreboard by debt, and you are moving that, we are looking at you and we think, no, you've got a great business.
It is simplest form. That's exactly what it means. And we'll come to the income statement because I think it's quite important we have a conversation about really how you grow the equity portion.
Yeah.
Because it's that income statement linkage that comes in, and we'll unpack that in its simplest form as well.
Let's take a call very quickly. Piri in Alex, good evening to you.
Good evening.
There you go. Go for it, Piri.
Thank you very much. Very insightful and very educational conversations you have in there in the studio.
Appreciate it, brother. Appreciate it.
So I wanted to ask. So my brother is running a small sponsor shop here where he sells his very tasty quarters with some chips inside and some archer on the side as well. So he would buy a number of loaves of bread and some bags of potatoes as well. He's got like 2 people that work for him. So what he does is that, at the end of the month, the way he basically measures how he did is that he has enough money to be able to pay off his employees, and he's got a little bit as well. I think he does not really care how much he has to be able to put in the bank, which I suppose that would be his value creation, as it were. What I wanted to ask really is that the niece here would often when she goes to school get herself 2 apples and some chips as well. Where on the balance sheet does that go? And how can that be accounted for? So basically, the personal use of the assets, as it were, of the company. And another question. Obviously, I know there's a whole lot of laws and policies and standards that are applicable in the world of accounting. I understand that there is a difference between your profit that you make in terms of accounting and the profit that you then say it's money in your bank. How is that being determined, as it were, and where does it also feature on the balance sheet? One last question.
Wait, my brother, wait. Let's just deal with those that are there. Period, Alex, much appreciated. Go ahead, Andisa.
Yeah. So, and I'd like to address maybe the issue of personal use of money in the business, and this is, I think, where we fell short as entrepreneurs. And by the way, again, in the show that you mentioned with Papaji, there was people who saying we're not saving enough, and this is for me where the distinction must be clear. So the money of your business is not your money; it's the business's money, right? And there's 2 ways that you can pay yourself, or 3 ways, right? It's either you take a salary, which becomes part of the operating model, or you pay yourself bonuses, so not operating model, income statement, because it becomes a cost in the line. And by the way, the sales that you make must be able to cover that cost, right?
Salary, yeah.
That salary. Or you pay yourself a bonus, by the way, which means, by the way, after covering all the costs, and we'll unpack the financial statements in a bit, you are then from the surplus are able to allocate yourself a bonus. Or you can pay yourself dividends. By the way, dividends are basically the returns that shareholders have. Unless you don't have those three ways of getting the money out, I would argue that you are stealing from your business. Because whatever cash it generates, and you cannot account for it in those three.
But I'm
ways.
the owner. What you're talking about?
No, you are the owner, but you are killing it. Remember, we spoke about value creation and remember the money that the business generates is not like a salary and I know a lot of people have got that temptation. But if you're serious about building the value, you need to be disciplined about how you take out the money. And I've mentioned three instruments now that says it's either you work in the business and you earn a salary at the end of maybe a quarter, or you pay yourself bonuses, and bonuses are normally paid based on achieving certain financial targets that you have set or stretching them, right? Or you've created enough value and you've got free cash that's sitting on your balance sheet as part of the cash, and you are able to pay yourself dividends out of that. You're reducing then the equity portion of the balance sheet. So these are really three ways. Otherwise, you're creating a situation whereby we can get to bankruptcy, which is what we are trying to get to shy away from. The bankruptcy is exactly that. That says you'll eventually end up in a position whereby the liabilities of the business are much, much greater than the assets that are available.
Give us the call.
Destroying value.
Yep.
Destroying value.
011-883-0702. My guest is Andisa Ramavhunga. He's chief advisor at Ntiyiso Consulting. We're talking about jargon, some of the concepts that we need to understand as entrepreneurs. And for me, the big one today is the balance sheet.
Yeah. Well, financial income statement is very important, and I'll maybe if you give me a moment.
So income statement is not balance sheet.
No, it's not. It's not. So so I mentioned that the balance sheet is the one that shows you whether you're creating value or not. The financial statement doesn't tell you that, because look, in a way it does, because the surplus that you create, you will be able to say whether you are increasing the pot or not. That's what basically if you think of your balance sheet as a pot, the financial statement tells you how you're increasing that pot on a year in, year out, month in, month out, quarterly, quarter in basis. And that one is very simple again to understand, because you first have to sell goods. I did say ultimately it's the market that funds. And the first people to get paid are the stock guys, the guys who provide you with stock. So that's why we get this line item called cost of goods sold. And then you after that you have what we call a gross profit. After that, you then pay people who are doing overheads, yourselves obviously included in the people who are doing marketing and so forth. And then you have what we call an operating profit. After that, there are two people who are very important. It's the banks with the interest, and voila, the taxman that you need to pay.
Yeah, he's
and
always around.
Yeah, and then you have what's left at the end,
the taxman,
which is the surplus that says we are creating value. Or okay, to say this year we're able to maybe bank.
So value is after everybody has been paid.
Everybody has to get paid.
Then you've got value.
And that's the value you are then taking back to the pot, which is the balance sheet. And how you, for those who are interested in accounting, and how you allocate or account for it in your balance sheet is that equity portion, which is called the retained income, if you've heard the the term before.
So value is what is left after everybody has been paid. The taxman and yourself.
Yeah.
That is the value of the business.
That is the value.
I want to give you
it's the value that you're increasing the business by. The value of the business is the balance sheet, right? So I said, think about the pot.
Yeah.
So how you grow the pot is the value of the business. But the function of how you grow the pot is how much you're pouring into it.
Yes.
Which is the income statement.
Right.
Yeah. So the income statement will tell you whether you are profitable or not. Right. But let me give you a hypothetical example, particularly for startup. So you might look as if you are profitable if you look at the income statement. But guess what? You are trying to close off debts and so forth.
So you're involved in some creative accounting there.
No, well, debts that because you would have used a debt to start up the business and get some equity portions as well.
So I want to tell you something.
Yeah.
And I'm not yet sure what the story is going to reveal. Brajo owns 2 taxis there in the township. And Brajo has now gotten a reputation as being miserly, stingy. Brajo. We know he's got 2 taxis, and their taxis are running very well. And every day we see the people coming in that work for him, that are driving the taxis. They bring in the checking every evening. The money, there's an envelope that comes from each driver, and it's delivered there. We know, Brajo, that there's money that comes in every day. But Brajo, he's miser. He never gives you any money. He says he doesn't mind. But we know, even his drivers, they tell us they make about 500, 600 rand a day. After the taxi has driven, it's full, it's got a full tank. To start the next day, everything is clean, the taxi is clean. Brajo has got 2 envelopes from his 2 taxis, and he's got the money that then tomorrow he goes and banks that money in the bank. But Brajo, if you ask Brajo for 20 rand, he says he's got no money. This has got no money. Is that what you're talking about?
Yeah, which is
Brajo
true.
saying that the money that he is receiving in those 2 envelopes from his drivers, that is the money of the business, not his money?
Absolutely. And then Brajo's is I like the analogy, because if you think about Brajo, he's got what we call, when he starts out, assets, which are 2 taxis.
Yeah.
And how maybe he funds them is he gets a 50% a loan from a bank. And
let me tell you about Brajo.
50% in terms of his own skin, right?
Let me tell you about Brajo. Brajo used to work for Patco.
Yeah.
And then he received his pension.
Yeah.
He bought 2 taxis with those cash. Doesn't owe those 2 taxis. That's his skin in the game.
Yeah.
Is that the skin in the game?
That's the skin in the game. That's the skin in the game.
So he doesn't owe those taxis. They are his because he doesn't owe them, right?
Yeah.
That's the value of Brajo's taxi enterprise at the moment.
Yeah, absolutely.
Those 2 taxis.
Yeah.
And now Brajo hires 2 guys to drive his taxi.
Yeah.
These guys, they go over on the street and they make money, or they bring the 2 envelopes with a little bit of cash inside, and then Brajo takes that money, and in the morning his wife takes the money and he takes it to the bank, and they bank that money. When I go to Brajo and I say, please Brajo, borrow me 200 rand, Brajo says I don't have money. But we saw him, he has got money. You are saying to me that he doesn't have money.
No, he doesn't have money. It's the business.
So he's telling
money.
us the truth.
He's telling you the truth. Because and this is the interesting thing about Brajo. So he starts out with 2 taxis that is fully funded himself, meaning that his balance sheet is basically his assets equaling his skin in the game, right?
Yeah.
But think about how he's growing his balance sheet. Every night Brajo is taking in those 2 envelopes, and he's growing the asset base of the business. So in day 2, he has the kumbis plus the cash in the bank equals to his value of the business.
So the lion is laughing at me. He says, income statement can never be a balance sheet. Income statement, bottom line, is not necessarily money in the bank. Balance sheet is all owner's contribution and liabilities.
Yeah.
Is that true?
So liabilities are debts, and owner's contribution is skin in the game that we're talking about.
Anyway, here are some of the questions coming from our listeners. Good evening, Bra Ops. Could you kindly ask your guest to give example or breakdown of a balance sheet for a waste collector who's operating through their own company? That would be my liabilities and equities. That's Tebza.
Yeah. That's we spoke about value creation because it's much, much more than that. Remember, I spoke about operating decisions and so forth. But let me maybe simplify it for Tebza. So the waste business will have trucks, obviously, which would be assets. And I'm thinking that it will have, because it's been operating in a while, it will have some cash, if as part of the assets, by the way. It will have some infrastructure where he parks. And this is where it gets interesting, right? If, for example, you decide, and this is now an operating activity, that you're going to lease out a space to park your truck. You don't realize that in the balance sheet. But if you're going to buy a facility, a plot of land, and you are going to park your trucks there, then you put that in a balance sheet as land and property, so long-term assets. So that's on the asset side. And I could break it further to maybe elaborate the point. So you come to the other side to say, how are these assets funded? So obviously the cash is not funded because there's cash in the bank. You hope that he got it through his own operations. But the trucks are physical assets. The land is physical assets. You come to this other side to say, how are they funded? How much of those trucks and land was bought through loans? So did he get, for example, a property loan for the land? And did he get a vehicle and asset finance loan from the bank for the trucks? And how much of the deposit did he put in himself, which would be the equity portion? So those are in a nutshell, if I was to paint his balance sheet, this is how it should look like. But as entrepreneurs, this is where it gets interesting, right? I mentioned there's an example, by the way, that now talks to the strategy element, where you can actually be in a waste business without owning any trucks. Remember, let's take the story of Uber, for example. If we were to look at Uber doesn't have any taxes in their balance sheet. Not at all, right? It will probably have things like software. It will have IP, like you've mentioned, built over time, probably some cash that's sitting in there and some buildings they own around the world, and yet they're in a taxi business. But this is where now you leverage on the business model and see how it's structured. So that's why it's quite important. And I said there's a linkage between what the choices you make on the desirability side and on the work to be done, because that defines now the types of resources that you need. Which ones will be capital, which ones would be operational, which ones would be outsourced, which ones will be insourced, and so forth. And all those decisions impact on the capital structure that you have in your balance sheet.
Right.
Yeah. How, for example, what type of assets you then have in your balance sheet, and obviously the funding that goes with it.
I want the next conversation we have a real separation of the balance sheet and the income statement. I really need to separate those issues. I think I've got the concept of the balance sheet. Yeah. That's the story of this thing. ¿Qué pasa, businessy? Was that? But Bralaki in Pretoria says, how does the order book affect the value of the business? Yeah.
So depending how it sits like, because it can get very technical, right? And it could be, by the way, an asset if it's contracted value, but yet to be realized. So it can sit as an what do they call this, income that you are about to receive. But obviously you then wind it down as you deliver on that business, because you need to either convert it to cash in the bank. That increase the equity portion. So those ones are a bit of a more complicated, I guess, ways of recognizing assets in the. But if you think about it, order book is an asset, because you're still going to, and it's an asset, by the way, only as far as you can operate on it profitably. From that other side,
there are guys that are lending money to businesses on the basis of an order book.
Yeah.
So I mean, if we are also talking about how do we raise capital, so that order book would be part of the assets that the funder would be looking at in order to
balance sheet, Aubrey. Balance sheet. Yeah. Right. So the order book will be sitting on that other side as an asset that you can. Excuse me for misusing this word, leverage into cash flowing your business.
So Collins says, Basil Collins says, income statement, balance sheet, and financial ratios. Until a business presents me that can't say if the business is profitable. Debt is a tool. Use it wisely. I don't know what that middle sentence is, Basil, but I think I can take away that idea that debt is a tool, right? It's not a condition in the business sense. That it's not a condition that you can permanently stay in.
Yeah.
It's a tool that you can use to create value.
So whoever buys your business will always discount out the cash. They'll never think of, the debt. They'll never think of the debt as priced into the business. They'll want to see the value of the business minus the debt out. Because remember, debt, as I've said, is liabilities. It's money that you still need to
pay back.
To pay back. It's not necessarily value. But obviously it helps in us creating value, because I've said that the debt you take to buy assets, and those are the assets that you then can sweat, that then brings in the retained income part of the balance sheet. And this is how you then grow the pot. So think of these two statements exactly as that, Aubrey. So you've got a pot, a 5-liter pot, and when you start, it's empty. The income statement is the one that's filling the water into the pot.
Yes.
So tomorrow the water would be 500 milliliters. The other day it will be a liter, up until you get to a 5 liter. This is how you and part of it obviously is how you then structure.
Then when you reach 5 liter, then you've realized full capacity.
Yeah, and that's the value of the business. You've grown now the business.
Now you must scale.
It's part of scaling.
Yeah.
It's part of scaling.
Okay.
Yeah. It's part of scaling.
Listen, I'm loving this MBA.
Say applied MBA.
I'm loving it. Listen, I'm really, really loving it. And I'm hoping that, as we sharpen the minds of our entrepreneurs to understand why we need these documents, what is a balance sheet? What is an income statement? For what purpose? What is value? All of those kinds of things. That is sharpening, I would imagine, the minds of entrepreneurs in the value creation process.
Maybe as parting shots. So the financial statement will tell you, the income statement rather, will tell you whether you are profitable or not.
Right.
The balance sheet will tell you whether that business is creating value or not, in simplest form. The two are linked, because whatever profitability you have on the other end comes back to the pot as the one then that grows.
How do people get in touch with you?
Yeah, so still on my email,
Yep.
info@ntiyisoconsulting.co.za. But I'd like to mention that we are now probably 2 episodes away from finishing the podcast. So there'll be a lot of this stuff being unpacked there, and we'll have a greater opportunity to link the strategy to all these concepts around financials. As I've said, the financials are the scoreboard, right?
Sure.
And numbers don't lie. And that's where you'll see whether you're creating value or not.
Andisa Ramavhunga, thank you so much for joining us, Group Chief Advisor at Ntiyiso Consulting Group, as we continue to sharpen our minds in order to be better hunters.